All right, so here at Charles Schwab IMPACT, we're joined now by Kathy Jones, Charles Schwab's Chief Fixed Income Strategist. Here, obviously a lot of buzz around here at the moment, and especially a lot of buzz after the elections as well. A lot of people wondering then, what can they expect as we're looking at some of these trends that we're seeing, especially in long-term bond yields? What are you keeping an eye on at the moment?
Well, we have a whole sort of trifecta of policies that could have an impact and send yields higher, but we don't have any clarity around whether those policies will be implemented, how they'd be implemented, or what the long-term effects might be. So we have tax cuts. Those are probably a ways down the road, but that could increase the deficit and actually speed up an economy that's already growing at a pretty healthy rate, and that might give us more inflation. You have tariffs, which have been the big topic of conversation, and that can give us at least a one-time price increase as those imported goods are priced higher, and that's passed through to consumers, another potentially inflationary policy. But offsetting that is that it could slow growth because you get less business investment domestically if that happens. And then the third is immigration reform, which, if implemented as discussed, we could cut back on the size of the labor force substantially, up to maybe 8% of the labor force, and that probably would boost wages and slow growth as well. So we have all these policies, we have no clarity about them.
So, given that uncertainty, we're still watching bond yields rise right now, so we're looking at a probable case of maybe higher, the market's anticipating higher inflation, et cetera.
Yeah, exactly. So there's something called the term premium, and that is the extra yield that investors demand to buy long-term bonds and hold them versus just buying short-term bonds and rolling them over. So if you buy a 10-year bond, you want to get a yield that gives you some compensation for the risk that short-term rates are going to not do what the market expects, right? So what we've seen is a term premium, which is kind of a risk premium, has been moving up. It was actually negative last summer and fall, and it's moved into positive territory. It's not all the way back at the long-term average, so it could rise further, and that, I think, is the main driver between the rise in yields, along with the fact that we've had better than expected economic growth.
So then in terms of the domino effects, because we know long-term yields tied to mortgage rates, people are hoping for some more relief on that front. What are some of the domino effects, and what are some of the strategies that perhaps investors can use to counter them?
Yeah, so mortgages obviously very much tied to long-term rates, and that's the housing market has been kind of moribund for quite some time. When I look at it as an investor, there's a two-edged sword here. So yields are up, and yields are at pretty attractive levels relative to current inflation. So I look at that as an opportunity. I want to be in higher credit quality bonds. I don't want to go too long in maturity because that gives you a lot of volatility. You measure that by something called duration, meaning how much the bond price is going to move relative to inflation. But in general, you probably want to have a high credit quality bond portfolio, meaning treasuries, other government-backed securities, investment-grade corporate bonds, municipal bonds, things with high credit quality, but not too long in duration, so you're not kind of caught up in the swings in the long end of the market.
So what about retirees who are looking at fixed income as a way to generate income in retirement? Do they need to reposition their portfolio?
Well, it depends on where they're starting, but I think they should take advantage of the current income that's available. We're looking at 5% plus in high quality bonds. That's a pretty good return over long, especially for a buy and hold investor, someone who's going to have it in their portfolio just to generate income. And the good thing about bonds is most of what you get is the coupon payment, the interest payment. That accounts for about 80% of your total return. So if you're a buy and hold investor, that's a pretty sound place to be during turmoil.